Something just changed in XRP that matters more than it looks. Over the past week, regulators and financial institutions across the United States, the United Kingdom, and Europe all made separate announcements that point towards the same structural shift. Individually, they seem technical, but together, they could reshape how XRP is used inside institutional finance. Today, we're connecting those developments to explain why XRP is increasingly being discussed, not just as a payment asset, but as an institutional collateral, what the misunderstood DTCC collateral rule actually means, and why the difference between transactional demand and collateral demand could become one of the biggest long-term drivers investors need to understand. This wasn't a week defined by price action. It was a week defined by infrastructure. The UK Treasury formally referenced Ripple multiple times in its wholesale tokenization blueprint. The DTCC launched new tokenized market infrastructure, with Ripple Prime participating in its collaborative working group. At the same time, HSBC received approval to issue the first on-chain government debt instrument with the Bank of England's digital security sandbox. None of these announcements guarantee XRP adoption on their own. But when three of the world's largest financial jurisdictions begin building complementary pieces of digital market infrastructure at the same time, it's worth asking a much bigger question. Are we witnessing another crypto news cycle? Or are we watching the early construction of a new institutional collateral system? Because if XRP's role is expanding beyond payments and into collateral management, then the conversation changes from short-term trading to a long-term market structure. And that's exactly what we're going to unpack. See, whenever cryptocurrency markets move, investors naturally focus on price. Green candles, red candles, daily volatility. But institutions rarely think that way. Banks don't build infrastructure because an asset's rallying. Infrastructure gets built because the financial system expects to use that asset for decades. That's exactly why the developments from this week deserve attention. See, individually, none of them guarantee XRP adoption, but collectively, they demonstrate something much more important. Infrastructure, regulation, licensing, settlement, collateral. These are the building blocks of institutional finance. And once those foundations exist, adoption becomes far easier than building them from scratch. Price is reacting, the system's evolving. And that's an important distinction. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. Perhaps the biggest surprise came from the United Kingdom. The UK Treasury released its official blueprint discussing the future of wholesale financial markets and tokenization. What immediately caught the attention of many analysts wasn't simply the report itself. It was that Ripple was referenced multiple times throughout the entire document. That means government reports rarely mention private companies repeatedly unless they are already considered meaningful participants in the ecosystem. This wasn't promotional language. It wasn't speculation. Instead, Ripple was referenced because of existing partnerships, infrastructure, and technology developments and deployments already operating within institutional finance. The UK isn't asking whether tokenization is coming, ladies and gentlemen. It's preparing for it. That represents a major shift. For years, tokenization has largely been discussed as an experiment. Today, governments are beginning to treat it as a financial infrastructure. And when governments begin designing infrastructure, markets usually follow. There's an interesting historical parallel here. During the Industrial Revolution, railroads weren't immediately valuable because millions of passengers suddenly appeared overnight. The tracks came first. The stations came first. The financing came first. Only after the infrastructure existed did commerce expand rapidly across entire economies. Financial markets often evolve exactly the same way. Infrastructure precedes adoption, not the other way around. That's what we're seeing today with digital assets. Many investors continue watching daily price movements. Institutions are laying tracks. The second development came from HSBC. The Bank of England approved HSBC to issue the first on-chain government debt instrument. Inside the digital security sandbox, that may sound technical, but it's actually historic. Government debt forms the backbone of global financial markets. Treasuries are among the most widely used collateral assets in the world. Moving those assets onto blockchain infrastructure isn't simply modernization. It's changing how settlement itself functions. Instead of waiting through traditional clearing processes, settlement can increasingly become programmable, faster, more transparent, potentially lower risk. Ripple has already built relationships across custody settlement and tokenization infrastructure. So while XRP itself isn't issuing government debt, the ecosystem surrounding Ripple continues expanding into exactly the markets institutional capital already trusts. That's a critical distinction. Institutions don't suddenly abandon traditional finance. They gradually digitize it. For years, XRP has primarily been associated with cross-border payments. And that narrative isn't wrong. Cross-border settlement remains an important use case. But there's another layer emerging beneath the surface: collateral. Collateral is what keeps modern financial markets functioning. Prime brokers require collateral. Clearinghouses require collateral. Derivatives require collateral. Repo markets require collateral. Margin accounts require collateral. Without collateral, modern finance simply stops operating. If XRP begins participating in the ecosystem, its economic role changes dramatically because payments create velocity. Collateral creates scarcity. And that's one of the most misunderstood concepts in digital assets. Now here's where it gets interesting. The DTCC recently launched new infrastructure designed around tokenized securities. For those unfamiliar, Depository Trust and Clearing Corporation processes enormous volumes of security transactions every single day. It sits near the center of American capital markets. Ripple Prime participated within the collaborative working group surrounding these developments. That alone attracted significant attention. But another topic quickly dominated social media: a collateral classification rule involving a $5 threshold. Unfortunately, many people interpreted it completely backwards. Some believed it meant institutions somehow wanted XRP to stay below $5. That's not actually how collateral economics work. In reality, the threshold functions more like a qualification level. Once an asset satisfies institutional collateral standards, its usefulness expands considerably. Rather than act as a ceiling, many analysts argue it actually creates an incentive for qualifying assets to remain above important collateral thresholds. That's an entirely different interpretation. Think about it this way. Imagine you're a large financial institution managing billions of dollars. You want collateral that's efficient, liquid, recognized, reliable. The better your collateral, the lower your financing costs, the more competitive your business becomes. This is why collateral quietly matters so much inside institutional finance. It's not about speculation, it's about capital efficiency. If XRP qualifies as an established collateral instrument under institutional frameworks, its value extends well beyond simply moving money across borders. Now it becomes something institutions may actually want to hold, not merely use. Hold. That's a profound difference. Here's the concept that may ultimately define XRP's future. There are really two entirely different forms of demand. The first is transactional demand. Imagine a payment moves from New York to London. XRP is purchased, transferred, sold. The asset performs its functions extremely efficiently. But once a transaction finishes, the XRP immediately returns to the market. Supply hasn't permanently changed. The same token can facilitate another payment moments later. That's velocity. Velocity supports utility. But collateral works differently. When institutions pledge collateral, those assets often remain locked inside margin positions, sometimes for weeks, sometimes for months, sometimes continuously as positions roll forward. Those tokens aren't circulating. They aren't available to everyone else. They're committed, and committed to collateral efficiently reduces available supply. Now, this is what most people miss. It's entirely possible for a transactional demand and collateral demand to exist simultaneously. One drives network activity, the other restricts circulating supply. Together, they create a much different economic dynamic than payments alone. Financial history often provides fascinating examples. Following World War II, the euro-dollar market emerged as banks began holding US dollars outside the United States. Initially, this seemed like a niche institutional development. Few outside banking circles paid attention. But over time, Those offshore dollar markets became one of the largest sources of global liquidity, fundamentally reshaping international finance. The transformation didn't happen because the dollar suddenly became more useful overnight. It happened because institutions found new ways to use the same asset within evolving financial infrastructure. That's an important lesson. Sometimes the biggest financial revolutions aren't created by a brand new asset. They're created by expanding the role an existing asset plays within the system. And that's exactly the question investors should now be asking about XRP. Is its role expanding beyond payments into collateral? If so, the long-term implications could look very different from the narratives that dominated the several last years. Now, this is where the story moves beyond theory and institutional implementation. For years, XRP's investment thesis has largely revolved around one core narrative: cross-border payments. The idea was simple. Financial institutions could use XRP as a bridge asset to settle international transactions faster and more effectively than legacy correspondent banking systems. The narrative still matters, but the conversation has evolved. Following Ripple's acquisition of Hidden Road and the continued development of Ripple Prime, the company is building something much larger than a payment network. Prime brokerage sits at the heart of institutional finance. It provides financing, margin, security lending, settlement, collateral management, trade execution, risk management. These are the invisible plumbing systems that allow hedge funds, asset managers, banks, and institutional investors to move capital efficiently around the global financial system. When Ripple Prime's leadership confirmed that XRP is expected to function alongside Bitcoin, Ethereum, stablecoins, and tokenized money market funds as part of this next-generation collateral framework, it represented a meaningful shift in how XRP is being positioned. This wasn't a retail marketing campaign. It wasn't driven by influencers. It was a discussion centered on institutional balance sheets. And that's an entirely different audience. One of the biggest mistakes investors make is assuming that every form of demand affects price in exactly the same way. It doesn't. Let's imagine a global payment worth $50 million. XRP facilitates a transfer. The payment settles. XRP is sold almost immediately after completing its role. The network has demonstrated incredible utility, but the tokens quickly return to circulation. Now compare that with collateral. Suppose an institution posts XRP against a large derivatives portfolio. Those tokens are no longer moving freely through the market. Instead, they remain locked while supporting financing agreements, margin requirements, or settlement obligations. The economic effect is fundamentally different. One creates transactional volume, the other reduces available supply. That's why many institutional analysts distinguish between adoption-driven demand and collateral-driven demand. Utility creates velocity, collateral creates persistence, and persistence demand often has very different market dynamics than short-term transactional activity. But here's where it gets interesting. If these developments were occurring in only one country, investors could reasonably argue that they're isolated experiments. But that isn't what we're seeing. Instead, we're witnessing progress across the world's three largest financial jurisdictions. In the United States, tokenized market infrastructure continues expanding through institutions like the DTCC, while Ripple deepens its presence in institutional financial services. In the United Kingdom, the Treasury has publicly outlined its vision for wholesale market tokenization, while the Bank of England's digital security sandbox is supporting real-world issuance of tokenized government debt. Across the European Union, Ripple has secured regulatory authorization under the markets in crypto asset framework, providing legal clarity for operating across one of the world's largest economic blocks. Viewed separately, each development is important. Viewed together, they suggest something much larger. The regulatory foundations are beginning to align. Infrastructure is beginning to align. Institutional participation is beginning to align. That's exactly how long-term financial transitions typically occur. Not with one announcement, but with dozens of coordinated developments that slowly reshape the system from underneath. Short-term noise, long-term structure. History offers another useful comparison. Imagine trying to become a global trading nation without deep water ports. You could produce valuable goods. You could attract merchants. But without the infrastructure to move cargo efficiently, large-scale commerce would always remain constrained. Digital finance faces a similar challenge today. Tokenized assets, stablecoins, central bank initiatives, and digital settlement all require infrastructure capable of handling institutional scale capital. Ripple isn't trying to become every financial product, ladies and gentlemen. Instead, it's positioning itself as part of the infrastructure that allows those products to move effectively and efficiently. Just as modern ports enable global trade to flourish, digital settlement networks may enable tokenized financial markets to expand over the coming decade. Infrastructure rarely captures headlines, but it often captures value. Now, it's important to separate what we know from what remains speculative. Here's what is supported by current developments. Governments are actively pursuing tokenization. Major financial institutions are issuing digital securities. Ripple continues expanding regulatory approvals across major jurisdictions. Institutional infrastructure surrounding digital collateral continues evolving. Those are observable facts, ladies and gentlemen. But what remains uncertain is exactly how much market share XRP ultimately captures. No one can actually predict that today. Some analysts project modest adoption. Others envision far more significant integration across payments, collateral, and settlement. The truth likely depends on several factors: future regulation, institutional preferences, competing technologies, economic conditions, execution by Ripple itself. Investors should distinguish between infrastructure being built and assumptions about ultimate market dominance. One is happening today, the other remains an open question. Think of the financial system like constructing a skyscraper. When people admire the finished buildings, they notice the glass, the height, the architecture. Very few people think about the foundations buried beneath the ground. Yet those foundations determine everything the building can eventually support. Tokenized finance is still laying many of those foundations: regulatory clarity, digital custody, settlement infrastructure, collateral frameworks, identity systems, compliance, liquidity. These aren't exciting headlines, but they're the components that determine whether trillion-dollar markets can safely transition onto digital infrastructure. If XRP becomes embedded within those foundations rather than simply existing as another tradable cryptocurrency, its long-term role could look very different from what many investors currently imagine. Again, that's not a guarantee. It's simply the structural transition many market participants are now watching closely. Now, this is what most people miss, ladies and gentlemen. Markets often focus on transaction volume. Higher volume is usually interpreted as a sign of growing adoption. But volume alone doesn't necessarily create lasting scarcity. Imagine an airport. Thousands of passengers pass through every hour. Traffic is enormous, yet very few people remain inside the terminal for long. The flow is constant. Collateral behaves differently. It's more like a long-term warehouse storage. Assets enter, then remain locked while supporting financial activity. If institutional collateral demand expands meaningfully, XRP could experience a structural reduction in freeing circulating supply. That doesn't mean supply disappears. It simply means fewer tokenized and tokens remain immediately available for trading. Markets constantly balance available supply against demand. That's why collateral mechanics receive so much attention within traditional finance. And it's why investors increasingly monitor them well within digital assets always. Price reacts to trading, ladies and gentlemen. Structure evolves through ownership. Looking forward, several developments deserve close attention. First, watch how Ripple Prime expands to institutional services. Second, monitor additional tokenized securities initiatives from major financial institutions. Third, pay attention to regulatory harmonization across the United States, United Kingdom, Europe, and other major financial sectors. Fourth, observe whether additional institutions begin recognizing digital assets as eligible collateral. Each milestone individually may seem incremental. Collectively, they could redefine how digital assets participate within global finance. Remember, financial revolutions rarely happen all at once. They unfold gradually, then suddenly appear obvious in hindsight. This week's announcements weren't simply about XRP. They were about the architecture of tomorrow's financial system. For years, discussions around digital assets centered primarily on speculation. Today, the conversation increasingly revolves around infrastructure, licensing, settlement, tokenization, collateral, institutional integration. Whether XRP ultimately captures a large or modest share of that opportunity remains uncertain. But one thing is becoming increasingly difficult to ignore. The infrastructure surrounding institutional digital finance is no longer theoretical. It's being deployed. Governments are writing frameworks. Central financial institutions are testing tokenized markets. Global banks are issuing digital securities. Prime brokerage platforms are expanding digital collateral capabilities. And Ripple continues positioning itself within many of those conversations. As investors, it's easy to become distracted by daily price movements. But markets are often transformed not by the headlines everyone notices, but by the infrastructure almost nobody discusses. History has repeatedly shown that financial systems evolve long before prices fully reflect those changes. The investors who focus only on volatility often miss structural transitions taking place beneath the surface. So whether XRP ultimately becomes a dominant institutional collateral asset remains to be seen. But the direction of travel is becoming clearer. The discussion is shifting from possibility to implementation, from experimentation to infrastructure, from isolated pilots to interconnected financial ecosystems. And that may prove to be the most important development of all, because short-term noise will always dominate headlines, but long-term structure is what ultimately shapes markets. If you've enjoyed this deep dive into the structural evolution of digital finance, make sure to subscribe to the channel, because every week we cut through the headlines, separate speculation from reality, and uncover the macroeconomic and institutional trends that could shape the future of crypto financial markets and the global economy. Till next time, thank you for watching. Stay informed, stay disciplined. I'll see you in the next one. Love you all.